Hi, you guys. I have Murphy here with us today, and Murphy is a recent UT Tyler Souls College of Business graduate. He graduated with his management degree, and he has some questions for us about his taxes. He tells us he's going to be making $55,000 a year in salary. And then he also tells us that he has a bank savings account that earns a little bit of interest, but he didn't take any of the interest out of his bank, and he's wondering if he has to pay taxes on that. He has some other stuff like he's paying off his car loan, so he pays interest on that. And does he have to, or can he get a deduction for that? What else? He also got a gift from his grandma for graduation, and it was $1,000, and he's wondering if he's going to have to pay federal income taxes on that. So we're going to go through just a few things with Murphy to help him understand some basics of taxes. And it's going to help you guys out through the rest of the semester to get a few of these definitions and terms down. Okay, so I've got some stuff on the board behind me. I've got four terms: income, exemptions, deductions, and credits. And we use this for everything in tax. So it's really important that you understand what these are and the differences before you can move on to anything else. Income is kind of what you expect. Um, Usually some money you got for something. So a little bit difference in individual income taxes and financial accounting according to GAAP rules. For individual income taxes, most individuals are using the cash basis, meaning they report income when they actually get some cash and not like when they did the work like we do with accrual accounting, okay? But then we've got this word exemption. Exemption means I recognize that we got some income, but we look to the Internal Revenue Code, which is a book of laws Congress has passed, just like any other law Congress passes. And sometimes they say, yeah, we recognize that's income also, but here's a special provision in our code that lets you exempt it from taxes. Then we have something called a deduction that says, usually you've spent money on something, and so we're going to take all of your income and reduce it by the deduction. And there's just a list of things, again, in that book of laws that Congress says, oh, you spent money on this? Okay, we'll let you take that as a deduction. It's like an expense in financial accounting. But Congress has to say, okay, we'll let you take it as a deduction. And it reduces the amount of income that you've have to pay taxes on. So stop right there. Do you see the difference between an exemption and a deduction? That's one thing that students struggle with in the beginning with taxes. An exemption says, this is some income that I got, but Congress says, don't worry about it. You don't have to pay taxes on it. Whereas a deduction is usually, I've spent some of my own money and I'm going to get to use that amount to reduce the income that I pay taxes on. Okay. And then finally, there's something called a credit. This is once you've figured out how much tax you owe, you're going to get to take this credit that you got and it just starts wiping out the amount of tax dollars you owe dollar for dollar. So a little bit different than a deduction. Okay, let's use the example with Murphy, our UT Tyler Souls College of Business Management graduate. He got a job paying $55,000 a year, and we're going to go through this list of things and try to figure out what it is and how it's going to affect Murphy's taxable income, because not all income that we earn ends up getting taxed. So we go, is salary taxable? Sure enough, darn it, Congress tells us yes, salary is taxable. That is an item of income. So I'm going to start at the top of my tax return saying, there's 55 grand I got to pay taxes on. And next I look at interest earned in a savings account, $700. But remember, Murphy told us, I haven't touched it. It's still sitting in my savings account. I didn't cash it out. They didn't give it to me in a check. It's still sitting there. Doesn't matter. Congress has basically said if you have access to the money, if you could take it out, even though you haven't, we're going to go ahead and tax it this year. So when I read that, I've got three different things that start off with interest here. But when I read this, I'm focusing on the fact that it says interest earned on a savings account. That means I got something. So that's income and not a deduction. I didn't spend it. I earned it. So we're going to add this $700. And okay, I've got an expense. and an expense. I'm going to stop here with this gift from Grandma. Grandma gave Murphy $1,000. So I go, okay, Murphy, that is income. But now I look at the code, the Internal Revenue Code, and I say, does Congress tell me anything about this? And lo and behold, Congress says, that's going to be an exemption. We realize it's income, but we are exempting that from federal income tax purposes. So I get to say, yay, I don't pay taxes on that. Y'all, even if your grandma gives you $10 million, the person receiving it never, ever, ever, ever has to pay taxes on it. There's something called a gift tax where grandma, the giver, the donor, might have to pay taxes, but the person receiving a gift never pays federal income taxes on it. So I'm just crossing that out. And for tax purposes, these now are my only two items of income. So I have what we call 57,700 of gross income. Okay, now I'm going to deal with this other stuff. Interest expense on a car loan. An expense means, as opposed to up here where we earned it, it means I've spent money on it. I paid someone, or Murphy did, $800 in interest expense. Well, Murphy is only an employee. He has salary of 55 grand. He does not own his own business. So in that case, if it's personal interest on a car for 2024 anyway, laws can change any year, every year, but currently for 2024, interest on a personal car loan is not deductible. So I am not going to do anything with that. Well, I've got one more item here that we have not addressed. Can you see all that? The last one says interest paid on a student loan. Now look, this is the same kind of interest up here. We paid it in both situations because we borrowed money from someone. The difference is that Congress says you cannot deduct interest on a personal car loan, but you can deduct your student loan interest. So, couple of things about that. Stop first and think, why? Why would Congress let you do one or the other? Well, it shows that Congress is prioritizing U.S. citizens getting a college education. They know that's better for our country and better for our economy if we're college educated because we're way more likely to stay employed and make good money and not have to rely on the government for welfare or any other kind of help if we're employable and working. So they go, yes, go take out loans if you need to. Of course, there's pitfalls in everything, right? But that's Congress encouraging that. So, okay, what are we going to do with this? Interest paid on a student loan, $500. First of all, that is not an item of income. We paid it. So it is a deduction because Congress says it is. So we subtract it from our income. And now we get to an amount called 55,200. Okay, these have names. I called this gross income. And remember, everything we're doing in here is for federal income tax purposes. We can't be bothered with financial accounting and GAAP anymore. And sometimes that's a problem because you start smushing those two rules in your head. So that's gross income. This is something called AGI. And so in between, this is called a 4 AGI deduction. I'll explain that in just a second. AGI stands for adjusted gross income. It's really important for tax purposes because Congress bases a lot of things off of this AGI. If you make too much money and they look at your AGI, they go, oh, never mind, you can't have that deduction. You can't have that credit. We're going to charge you more here. We're going to charge you more there. So AGI is a very important number, but we still have one more step to go before we get to what's called taxable income, the amount of your income the federal government's going to tax. This last step is there's another deduction, and I'll compare these in just a second, but it's called a from AGI deduction. And for now, I'm just going to use what's called the standard deduction. So Congress says, hey, I don't care who you are, how much money you make, what you do. We are going to every single year give you an amount that says you don't have to pay taxes if you earned less than this amount. So I'm going to see if I can pull this up on my screen real quick. Okay, carry on. I can't make my screen share while I'm doing this video. I know I can, but I can't do it right now. Okay, so I jotted something down real quick while I was trying to share that. The standard deduction for 2024, if you are a single person, that's what my S up there stands for, is 14,600. Stop and think about what that means. It means if you make less than $14,600, you will not have to pay any federal income taxes. So the purpose is Congress is shielding a little amount of income each year, saying, man, you need at least $14,600 to eat, live. We all know you need more than that, but that's what they're doing. They're shielding a basic amount of income from taxes. This gets adjusted for inflation every year. So I jotted down the 2025 number while I was looking at it as well, and that's $15,000. It's doubled if you're married and you file your tax return jointly. You get um, double what each of these are. Okay, so let's go back to Murphy. We are going to learn a couple more terms. Murphy is still single. He is going to take the standard deduction of, let's pretend it's 2025, $15,000. So Murphy has what we call taxable income of 4,200. So stop again, pick your head up out of the details and look at the big picture. Murphy really had income of 55 grand plus 700 plus 1,000. So what we see here is that not all of our income is taxable. In fact, something like 47% of people who earn some income in the US don't pay any taxes. What? Half of our population does not pay taxes because of this shielding of income and exemptions and some credits that we'll get to later. Okay, next thing I want to focus on, there is another thing Murphy could take other than the standard deduction. I'm not covering that in this video. That's itemized. We're just going to cover it this way. What I want to focus on now is a for AGI deduction or a from AGI deduction. Again, it's one of those things that students struggle with a lot in the beginning, and you've really got to get a hold of this because it affects everything we do in this class. Notice how both of these amounts, whether I labeled it for AGI or from AGI, what do? They both reduce the amount of income we have to pay taxes on, right? We subtracted it both. So what's the difference if they're both a deduction? The difference is in just where they are, and Congress tells us if it's a for or a from AGI. So why do you care? Well, remember when I said Congress uses this AGI number a lot to figure out if you've made too much money to get certain deductions or credits or things? So you'd rather it be a for AGI deduction, even though they both just reduce your income the same. But if it's a for AGI deduction, it's less likely to be taken away from you, and you still get the standard deduction on top of it. So there are other things that are from AGI deductions called itemized, and there are certain thresholds you have to meet. You have to have this many of them to be able to take it, or otherwise you just get the standard. So we'd rather it be the for. All it means is the for AGI deductions happen before you get to AGI, and the from AGI deductions are taken from AGI. But what we'll start focusing on now is going through all these different deductions and figuring out what is what. So here's one that you've learned. Student loan interest, Congress has said, is a for AGI deduction. They really want everybody to be able to take it. Although later on we'll learn there's always exceptions to the general rules in tax. I always say if you see a multiple choice answer on the CPA exam for tax that says it depends, that's the right answer because it always depends and there's always exceptions. You won't see that as an answer choice on there, but if you did, that's what you'd pick. So, okay, hopefully you've got down, stop and replay, see if you can explain it to your cat or your dog like Murphy, the difference in income, exemptions, deductions, and credits, and what the difference is in a for and a from AGI. And then again, hopefully you can see that just because we have income doesn't mean that we pay taxes on it. Our taxable income that we finally get down to is the amount that we pay federal income taxes on.